look, I think most of the people looking to figure out how to diversify some of their investment portfolio, they're looking at deals. They've probably already invested in one or two. How can DLP Capital help someone like that?
So at DLP, we have basically 4 funds. We have 2 debt funds and 2 equity funds. Yeah, but equity is so hard to get right now, everybody. In the market we're in, at a high level, there are 3 things when you think about risk. Number 1 is the sponsor. Number 2 is the market. Number 3 is the project itself. I would say learn as if you were to live forever and live as if you were to die tomorrow. Modern day survival skill is learning how to manage your wealth.
Hey there, and welcome to another episode. My name is Pascal Wagner, the host of the Grow Your Cashflow Podcast. If you're new here, we help accredited investors grow and diversify their monthly cash flow through low-risk private placements. To be clear, we are not financial advisors providing you advice on your specific situation, but our email list, our social content, and even this podcast are all designed to help you learn how to find and vet passive income opportunities so that someday when you're looking to grow your cash flow that you'll consider any one of our funds and working with us. So even at the very least, we wanted to accelerate your ability to gain financial freedom. And today I have on the show Bo Parfet from DLP Capital. So let's dive in. Okay, so welcome to the show, Bo. Today we have a very special guest who will be helping our listeners on their path to achieving financial freedom through passive income investments. Bo Parfet is the managing principal and head of growth at DLP Capital, and he is here to share his expertise and insights and just kind of share how DLP can help you achieve your passive income goals. So to give a little intro to Bo, Bo's the managing principal at DLP Capital, which is known for its impact investing. And with a background in economics and a career that includes investment banking at JP Morgan, I think he's an expert here. So for Bo, for those that don't know you, can you share a little bit more about yourself, your background, and how you ended up at DLP Capital?
Yeah, you bet. Pascal, thank you for having me. Thank you to you and your great community. It's an honor and privilege to be here. So thank you. So happy to provide a little nickel tour of my background. I'm from the Midwest and came out to Colorado for undergrad. I worked at a restaurant 50 hours a week, put myself through college. I absolutely loved it. And I had a friend at the time, and he kind of taught me how to flip some lots. So I started flipping lots in college, and I kind of thought I was, big stuff. And boy, was I about to be humbled. So then I tried to go to then I tried to go to New York City and learn investment banking. And they said to me, it was at Solomon Smith Barney. The guy said to me, he goes, "You're not getting a job here, Bo." I go, "Well, why not?" He goes, "Because you didn't go to a feeder school." I'm like, "What's a feeder school?" I didn't even know what that was. This guy happened to go to Penn. He's like, "Well, it's the Ivy League." And he goes, "And then it's some good state schools like Michigan or Virginia." So I was like, "Hey, Michigan, I've always wanted to go there." And so anyway, that weekend, I was so fired up. That weekend, I went and applied to get a master's in applied economics. I started the process that weekend. And the funny story, just to close the loop on this, is that a year and a half later, right? So now I'm at University of Michigan. I'm in the master's program. I go back to New York City. I interview with Solomon Smith Barney, the same guy. It's the same guy. Love it. Yeah, right? And I knew that I was going to see him, and I'm like, gosh, it's been a year and a half. And he was right, by the way. I did not get the job, but I was, hoping to, and I started to get a lot of offers. So anyway, the guy said to me, he looked at my resume and he's like, he pulls it up. "Oh my God." Hey, he goes, "Wow, you went to Colorado State for undergrad? I love Colorado. I used to ski there. And oh my gosh, you worked at a restaurant 50 hours a week. That's so cool. Great work ethic. Oh, University of Michigan, great school, great sports." And I realized he doesn't know who I am, Pascal. He doesn't know who I am. And then, so I kind of reminded him, and he goes, "Oh yeah." And I said, "Listen, I've been waiting for this for about a year and a half. And I want to thank you because you changed the trajectory of my life. It was your advice. I had no idea kind of how that part of the world worked. and thank you. And he jumped up behind his desk, walked around, gave me a big hug, and he goes, you know how many times I've told that to people and no one's ever listened? So that was kind of one of the many defining moments. I ended up doing mergers and acquisitions at JP Morgan. I was a fellow at FASB, and then realized, hey, I maybe there's something else besides, Wall Street banking. Working 100 hours a week, I gained 40, 50 pounds. Okay, wasn't a pillar of health. Then I got my MBA at Northwestern in Chicago, and then after that, I scratched an itch. I always wanted to be a professional mountain climber, so I got to do that for about 9 months, and that was tons of fun. But realized that I still want to climb, but not full time. I still climb to this day. And then I started my own business, everybody, and I started a student housing business. We grew that business pretty successfully, and we employed at one point about 200 people. We had roughly, we had more than 3,000 units, in 4 or 5 states. A long time ago, but it was an impactful part of my life because I got to start a business. We had a nice exit, and then I had a little dry powder. And what I tell people is the good news is I had a little dry powder and I made a lot of investments. And then the bad news is I made a lot of investments. And for those that are listening, I think there's a great quote that someone told me. They said, Bo, it takes a tremendous amount of effort to make a fortune or a nest egg, but it takes 10 times more effort to keep it. And I sure learned that the hard way. So I've got a lot of good lessons learned to share. I have a lot of good lessons to share, lessons learned. And then I heard Don Wenner speak, who's the founder and CEO of DLP, about 5 or 6 years ago at this kind of family office conference. I said, that guy has the eye of the tiger. I really like what they're doing. And I ended up joining DLP about 3.5 years ago or so.
So what happened then to your, student housing portfolio? Is that just like something you still kind of manage on the side? Did you merge that in? What happened there?
So we sold. We had a successful exit. And actually, Dan Gilbert, who owns the Cleveland Cavaliers, he bought a big chunk of our portfolio, which was pretty darn cool. We kind of thought Dan would be on the last call, but he never was. And I asked, I said, is Dan going to be on this call? And I think it was like 4 levels below Dan, who worked for Dan's family office. And he said, Bo, let me be very clear. He goes, Dan, he doesn't even know he's buying this. I'm like, it's like almost 3,000 units. What do you mean he doesn't know? So anyway, kind of a fun story there, very humbling. So end up selling that and then tried to do kind of my own investments and did pretty well in real estate, did pretty well in private equity and stocks. And then when I got outside of my comfort zone, it was really, some went well, some went horribly wrong. And then I did that for a while. And then I found DLP and I'm very happy that I found DLP and Don Wenner.
I love that. So give us kind of just a little bit of an additional background of maybe how much you've invested in other LP deals. So and the range of deals. Like it sounds like PE, sounds like a bunch of real estate, student housing. What are other asset classes? And is it like you've done 10 LP investments? You've done 30 LP investments?
Well, I also worked for another family office. It's hard to break down the entire background in a
yeah,
short.
Totally.
Yeah. So between working for a couple other family offices and doing my investments, I mean, it's hundreds and hundreds of investments and hundreds of K1s and 1099s. Yeah.
Okay,
so private equity. Yeah. Real estate private equity, kind of operating business private equity. Venture capital, largely unsuccessfully, some crypto, stocks, private debt, distressed consumer debt, bonds, muni bonds, corporate bonds.
Yeah, and so what I want the audience to take away from this is like, Bo here. I know Bo personally through this men's mastermind group called GoBundance that we've both been a part of. That's how we kind of got introduced to each other and why I kind of feel more comfortable asking these kind of questions to Bo. But what I want you to take away here is that he's also in the field investing on his own. We're going to talk today about DLP and how DLP can help towards that passive income journey and generating that monthly income towards financial freedom. But he's been on the front lines. He's done these types of deals. He's had deals go sideways, and he'll bring that perspective here.
Yeah, well said.
So look, like great background, now we know who we're talking to. Let's dive into the next section here when we're talking about just passive income in general. So when I look at DLP, I think of DLP Capital is known for its ability to provide consistent monthly passive income. I'm an investor. I have over $700,000 invested with DLP Capital. I've been in the fund for at least 5 months now. I'm launching a feeder fund into DLP. I'm just a huge advocate, which is why I wanted to have you on today. Give us,
thank you,
an overview of why investors maybe choose DLP Capital as one of the funds they invest in to generate monthly income.
Sure. So I'm going to unpack that in a couple ways. So I think first and foremost, if I'm in the audience, if I'm in your shoes, what are some of the key things that family offices or institutions or very knowledgeable investors are doing to decrease risk? Okay. So just some showstoppers for millions of people that are in that category. If you don't have a top 10 auditor, right, then just in my mind, and I'm not, institutions, family offices, high net worth individuals, like just delete the email. It's okay. We get so many deals a day. The goal is to delete the email as fast as you can. So we're looking for some things to do quick screens on, right? So a top 10 auditor is huge. And if they don't have one, delete. And if I go back in my career and every deal that went wrong, if I would have just, instead of taking, if they're a smaller operator, but they're hardworking and right? If I just stuck to that gun, I would have had a lot of investments not go south because I wouldn't have invested in them. I've never had an investment go south that had a top 10 auditor. Knock on wood, Pascal. Okay.
Yeah.
So a top 10 auditor is key. I like to have at least $1 billion. Many people do have at least $1 billion of AUM, right? Because they've grown, they've gone through, they're not learning on your dime. I like a 3 to 5 year track record, right? I don't know what the stat is, but 90-something% of all businesses don't make it past the 3 or 5 year mark. I want a top tier law firm to do their fund docs, right? Not kind of Uncle Joe. I want a great data room. I want a good investor portal. I want a great communication cadence. I want thought leadership coming out of the managers that I allocate with. I want pretty good returns. I don't want really volatile returns because in my mind they're taking on too much risk. So those are kind of the broad stroke characteristics of DLP checking the boxes. Okay, and to be clear, like I'm a big fan of diversification, and a lot of fund managers do meet those, and a lot don't. But DLP kind of checks those boxes for many people. We have about 2,400 families that invest with us. But then the other key piece is, I think you want to double click on this, is we're an impact company. And what an impact company means, everybody, is you can solve a problem in the world and you can make a financial return at the same time. That's pretty darn cool. That's having your cake and eating it too, right? That's pretty darn cool. So at DLP, it's our mission while we jump out of bed every morning is we're trying to solve the market rate workforce housing crisis in America. And that's pretty cool. And the beauty of it is there's a shortage of these units in America. About 7 to 10 million are kind of the range of estimates, but it's millions and millions of these units need to be built or converted to workforce. So the moment we deliver these products, to the marketplace, boom. They just lease very quickly. So it's a fun spot to be in. We are in a bull market. I know the market's a little bit in a turmoil now. So with humble confidence, we're in a bull market and our deal flow has never been higher. And it's really exciting to be a part of it.
Yeah. I think also just one of the things strategically that I think about with investing in this space, not only you mentioned impact, but, when you're going through economic turmoil, or you're preparing for a recession or a down market, I think one of the last things that you want to be doing is investing in things that are luxury, class A, top of the line things, right? Like if in a recession or depression or a down market, people are not, things aren't blowing up and people want to, have the shiniest car no, they're all downsizing. They're like, how do I pay less in rent? Oh, I need to move. I need to, and then things compress down to these smaller asset classes, or not even smaller, just lower in the rung, where it's like, okay, the people, the units that are most affordable become more in demand. And to me, that is one of the most exciting things as an investor trying to lower my risk and protect for the downside. It is exactly investing in asset classes like this one.
Well said. And I'll never forget this, but when I joined DLP, I went from making a living to making a life. And it's so fun for me to tell my kids, hey, our goal is, and you too, because we're doing it together. Okay. You're an investor. Our goal is to have 1 million people have a safe place to live that's affordable. That's pretty darn cool. So I love that. And for those that are very interested in passive investing, I love the cash flow piece, right? Because if it's cash flowing, it's already working, right? They have customers, whatever they're making is working. So the risk goes way down. And, the survivor skill of the modern time is learning how to manage your money, period. That's the modern day survivor skill. It's not back in the day where you had to learn how to fight off a saber-toothed tiger. Like learning how to manage your money is the modern day survivor skill. Very important.
I've heard this objection before, and I'd love to kind of just pass it on to you, which is, I'm all on board for this top 10 auditor idea. I think you do take on a lot more risk, and if they're not audited, and I think a lot of these deals are coming to light where these what I call them like indie syndicators or new ones, and there's nothing wrong with it, but there are a lot more deals that go sideways with that. The argument I've heard here is like, okay, well, Enron was, financially audited on the public markets, and there was still, let's say fishy stuff going on. And so how would you handle that objection? It's like, yeah.
So, very good point. Enron was, there was fraud behind there, and things went down, and there's other public companies have gone down, and for similar types of reasons. So thank you for saying that. I don't want to make it sound like a top 10 auditor means that it's bulletproof. Things can still go wrong. It's just the risk of something going wrong goes down, right? And then you and I have the same. We still have friends who like the smaller, house flipper or apartment flipper, and they're small and they do a couple deals a year. They don't even know how to do an audit, so they don't do one, and that's okay. But you trust them, and they're pretty good communicators. There's a case for that. I mean, if the biggest, the greatest defense, I think, is just diversification, right? So if you just take be very, very mindful of that. But you're right. I would say this though. I would say, all things being equal, if investment A had a top 10 auditor and investment B didn't, I'd choose that, right?
Totally.
But it doesn't mean it's bulletproof. So that's a good point.
Totally. So, I'm asking you these questions off the cuff here, but do you have any kind of success stories or case studies of families or individuals who've achieved financial freedom through investing or maybe partially investing through any one or multiple of your funds?
Absolutely. There's a lot of them. And we tend to attract people that are wanting to give back to their community or their world, right? And you're a great example of one. We're doing this podcast, right? You don't have to pour value back into your community, right? You don't have to do it. You could just receive the monthly distributions and do whatever you do. So many people that invest with us, have have figured this out. And what we say a lot of times is the two most important moments of your life are the moment you're born and the moment you know why. And a lot of people that invest with us have figured out their why. And those that haven't are trying to figure it out along the way, and that's okay. We can help them with that with our, some of the education that we do, the personal compass and the family compass. So we have, one investor that takes the distributions, and they have a nonprofit in Africa, and they're saving lives every day. That's pretty darn cool. We have another investor that it's grandma and grandpa, and their kids have kind of struggled a little bit with life a little bit, but they have grandkids. So they use the distributions to pay for their grandkids' college. Okay. I mean,
love it.
What a gift. I mean, no one can ever take your education from you. One thing you can't take, you can't tax it away. You can't take it away. So, there's a lot of people that take half of their income or 25% of their income that they get from DLP and others, and they give it to their charity or their church. So a lot of people are pouring value back into their community, or they go start another business, right? And we kind of help them start their business and float their P&L along the way. So there's just so many great success stories. So thank you for asking.
Yeah, different ways you can use it. Whether, just like you said, I'm using it to kind of like cover all my basic expenses. Have this become 100%er is what we call it in GoBundance, where your expenses are covered by passive income, and that this is one of the passive income sources that I use, kind of help reach that 100% freedom goal. So look, I think most of the people who are listening here are looking to figure out how to diversify some of their investment portfolio. They're looking at deals. They've probably already invested in one or two. And how can DLP Capital help someone like that, just grow their cash flow, increase that consistent monthly passive income? What are the different types of vehicles you guys offer that help someone towards that goal?
So at DLP, we have basically 4 funds. We have 2 debt funds and 2 equity funds. And that's important because when you look at your portfolio, we actually, we should be in, I would argue that we should be in someone's fixed income or debt allocation, but we should also be in your private equity allocation. That would be in the real estate bucket, private equity real estate. So we kind of hit 2 buckets, if you will. There's I'll just highlight 2 of them, 1 of each for time's sake. So our senior secured lending fund has a 9-ish year track record, $1 billion fund, has returned 10% plus net every year, and it's a great it has an 8% preferred return. One cool thing about DLP is our management fee is subordinate to the pref, which is very unusual. I don't think I've ever seen another fund do that. So the investor
walk through what that means. Yeah,
sure. So the investor gets their 8%. So just to take simple math, say someone invested $1 million. Okay, you're going to get your 8%, so $80,000 first. That'll be paid monthly, and then DLP takes the 2% management fee. Okay, normally it's the reverse for those of you listening. This is very unusual, by the way. So investor gets their 8% first, then DLP takes their management fee, and then you split 80-20. 80% of the profits go to the investor, 20% of the profits go to DLP, which is very favorable, by the way. Another thing to be mindful of that I don't do is some people out there don't do an 80-20 split. They're like, oh, let's split 50-50. And that's just more of a focused on a retail, kind of customer or client. Nothing wrong with that, but there's just so many deals out there and managers that you can actually get 80% of the profits as the investor. So more of it comes to you, which is something to take note of. So that's kind of our debt fund. We're making senior secured loans to real estate operators that have the same mission we do. So at DLP, we can be the operator ourselves, or we can back another real estate operator, again, that has the same mission we do. And when you're trying to solve this workforce housing crisis, you have to work together. So we put purpose ahead of pride. So that's why we work with many other firms. And then on the equity side, we have we have a building communities fund, which we're building about 10,000 units right now. This fund actually just won a huge award in New York City. I actually got to go to the red carpet. Yeah, you saw that. I was on the red carpet, and hey, we won the. So what's cool? So for those in the audience, when you do a ground up deal, usually you're hoping for kind of a nice return because there's pretty good margins when you build, generally speaking. But the problem is it takes them a while to build the 300 apartment units, for example, right? So for 2 or 3 years, you don't get any cash flow. So what DLP did is, and why they won the award is they just remodeled it, and they had the sponsor put up more equity and actually budget for current income. So you're getting an 8% preferred return in this building communities fund that's in the process of building 10,000 workforce housing units. And you can get paid along the way while they're building. So it was really, and that's why we won the award. And I think also because it's solving the workforce housing crisis. So those are two funds that I think are worth taking a look at. How about that?
So let's dive into that last thing that you just mentioned to clear it up a little bit. So meaning when you say the sponsor, so the sponsor is DLP Capital in this case, and DLP Capital is putting up, they have an additional $1 million, or I guess it's proportional to how big the fund is. If it's $1 billion fund, it's a lot more than that. But you are putting capital from your own balance sheet and paying investors an 8% pref on in that fund, so that investors can start getting some of those returns to maybe even out a lot of the volatility, and maybe it's able to do that. Yeah, walk through that a little bit more.
Sure. So, and you're close. You're really close to. So, and it's important for people to know, because one of the big differentiators for DLP, like if we compete against another lender, for example, right? So we're going to give someone a construction loan. Well, we build ourselves. Most lenders aren't real estate developers also, so they don't quite have the expertise that we have. Like we can actually look at a budget and go, you're low here, you're high here, because we're doing it every day, right? And then the borrowers like dealing with us.
Lowers the risk.
Yes, 100%. So, and then another risk if you're a lender is, oh my gosh, what happens if they're 80% through the project and the borrower can't, they get in trouble or something, they can't finish it? Well, if you think about it, if it's 80% finished, that's the least risky that loan has ever been in the history of the loan. It's not just a piece of dirt. It's 80% done. It's almost done. So our team can go in and finish it pretty quickly. So that's another scary thing when you're a bank or a private lender, is like the last thing you want to do is take over an asset because you don't know how to do it. We're more than happy. We don't want to do that, to be clear. Our loan to values are kind of in that low to mid 50s. Loan to cost is in that mid to low 70s. But if we have to, we're more than capable of doing it, right? Where a bank would really struggle with that. So that's one of our advantages. So so I just want to give that example. But to go back to, okay, we have this fund that's building new product. Now it's not Class A, but it's still really nice. It's brand new. Think of it maybe like new Class B, kind of the way to think about it. These are apartment buildings. In some cases, these can be single family home rental communities. So 200 homes, but they're all rental. The whole neighborhood is rental. That's a pretty exciting area. So in a case where DLP is building, in a case when in that fund, DLP could be the sponsor, okay? Or it could be, XYZ firm, right? So either one, but when we model it, when in order for us to fund that project as part of, and in that fund, the sponsor or the real estate developer, they actually pay for the preferred return in the first, call it 2 years when they're building. So they have to put up more equity, and they actually start paying that at 8%. So the investor can say, hey, I'm making 8% while they're building it. I don't have to wait 2 years to get that until it leases up for me to get that cash flow. And that's the kind of the big differentiator. Does that make sense?
Totally. Is that, I imagine, from these development firms, or if it's even DLP, is that from equity investors then, like
Yes.
someone else is kind of funding that. Got it. That makes sense.
Yeah, but equity is so hard to get right now, everybody. It is really hard to get equity. It's hard to get debt. So, in the market we're in, there are at a high level, there are three things when you think about risk. This is important. Number one is the sponsor. We look for people that on average have done at least 40 deals, like a 730 or 740 credit score, right? Big track record, big net worth, cash in the bank. So in this market, we can pick the best of the best sponsors. That's a wonderful thing. Risk goes down. Number two is the market. We track, markets win for sure. If you and I are in Colorado, if you and I did anything in real estate in the last 30 years between Fort Collins and Colorado Springs, we would have just won because the market's so strong.
Right.
Well, what drives a good market? Birth rates, cost of living, job growth, migration patterns, quality of life. So to recap, number one is the sponsor. Number two, it's got to be a strong market. And then number three, drum roll, please. Number three is the project itself. Okay. And is their construction budget in line or out of line? Are they doing all studio apartments when the market doesn't want that? They want 2 or 3 bedrooms. So really underwriting that specific project is key. And those are kind of the big three, let's call them the big 3 risk factors or opportunity factors.
I love it. You pretty much highlighted the thing I keep talking about on this show of the order that people should go in when they're starting to look at deals. I even add one more to the front end of that of just saying, when I have $100,000 that I want to invest, what do I want that money to do for me? Is it equity growth? Do I want cash flow? Do I want, tax benefits, or a combo of all three? Once you've decided that, you look at the sponsor, the operator. Do they have a solid track record? Just like you mentioned, is what they're doing in a solid market, just like you mentioned. And then the last thing is the deal. The deal kind of like triggers that train of thought. Like, when does that start my research? But you nailed it. So I love hearing that from everyone else over and over.
Awesome. And one thing you said that I want to comment on is like, how can people kind of grow their wealth and their passive income? I've been in finance most of my career. And it wasn't that long ago. So I'm 46. Maybe I was 38 or 35. That, oh my gosh, I can get a self-directed RIA. I can get a self-directed retirement account, 401k or and I didn't even know. I think I spent 12 years in finance before I'd even learn that. So that's a great way to allocate funds and have them grow tax efficiently. I don't think we can say that enough, right?
Totally.
It's a great place for people to find money that's not just stuck in some, mutual fund or something.
Yeah. So to just put some more on that point, it's like, when you're growing up and as you get into the corporate world, for example, maybe like all you know is the stock market because that's public and what's available. And they might fund a 401k or, a Roth IRA. And the only place you really know how to invest that are these index funds, or, you might get it set up through your brokerage account. But exactly, I'm actually going through that process right now because I've done so much LP investing with my normal money. I've started to think, wow, I should position all my things, put it into a self-directed IRA because I believe that the opportunities in this space, I just at least want to have the option to put my retirement money in these types of accounts. So plus one on that comment. I'm glad you brought that up.
Absolutely. And I think it's, people can Google this for sure. So please double check, but going from memory here, from 2000 to 2010, I think they call that the lost decade. So if you invested in the beginning of 2000 in the stock market, 10 years later, you had about the same. That's why they call it the lost decade.
Wow.
So private investments are, and by the way, it's easy to see. Go look at, Harvard or Yale's endowment. Go look at in public, what family offices, how they're allocating, right? Tiger 21, Camden Wealth, like a lot of these groups where a lot of very knowledgeable and sophisticated investors are members of, they publish their allocation. And many of them are 70 at a very high level, 75% private, 25% in public markets. So,
Yeah, it's crazy to think about when, most of the public, the common man invests in public markets and all of the wealthy are all in private markets. And it kind of makes you think, like maybe I should reconsider like investing in private alternatives or.
Absolutely. And, there's still a lot of financial advisors out there that they were just trained in public markets. They're not really comfortable. They don't know. And there's still kind of this 70-30, 60-40 stock bond portfolio. That's like stepping out of a DeLorean, with Michael J. Fox and Doc Brown, Back to the Future.
Well, something that I like to highlight is, look, like, I think what's important in this game of finance, and as you're considering investing your own capital, is that everyone has an incentive, right? So when you go talk to your financial advisor or you go talk to a broker, it's important to understand, like, everyone gets paid in a different way for pushing different products. And so, I've been talking to my Fidelity broker a lot lately just to understand what options they have, because they're pushing the options that they get compensated for. Just like DLP or, my fund, like, I'm going to push certain funds because we all get compensated in different ways. And so, just like as a educational moment, that should be like a little thing that's in your head that you think about as you evaluate all these different deals. And it's a matter of just having access and who you talk to.
Yep, absolutely. Good, really good point. And another big one I think is people always ask is, how do you really kind of start to grow the balance sheet? And I think, the number one, I love the book, The Richest Man in Babylon. It's a really short book. It takes like 30 minutes to read. Great parable book. A lot of parables in there, but if you can save 50%, 40%, 70% of what you make every year, and it's funny, we're part of this mastermind. I was talking to this guy the other day, and he goes, yeah, my lifestyle really has gone up because my income's gone up, and he goes, now my lifestyle has really gone up, so I could either cut back my lifestyle or I could make more money, and I'm just going to choose to make more money. And we just all started laughing. But to live in an enjoyable but humble means, and just compound those returns, and hopefully life is really long and people can enjoy those, But just to create that initial wealth, takes kind of 10 or 20 years. 10 or 20 years, head down, working hard, right?
Yeah. So look, I have this customer avatar that I like to put out there. His name's Richard Morgan. He's this 48-year-old guy that's, starting to think about retirement, and he's looking at all these different investments in these funds, and we've highlighted a little bit of them throughout our discussion. But maybe, like, what does DLP Capital do? What measures do they take in order to reduce risk, right? Like, when you're kind of getting in that stage of your life, you don't have as much time to make up investments going sideways. And we talked about audited financials, and you also do development yourself, and so you can take on maybe some loans that go sideways and finish them out. What are all the things that kind of reduce the risk profile for someone making an investment?
I love this saying that there's two types of pain in the world. There's the pain of discipline and the pain of regret. And, one of them weighs a hell of a lot more than the other. So I think that if this avatar, so he's 48 years old, what's his net worth?
Oh, man, it's a good one. I'd say net worth of $8 million.
Again, I've met a lot of people that don't quite have 8 million, right? Maybe they have 1 or 2. But if you take some losses, early on, it's just tough. It's tough to recover and make that other $100,000 to invest in something. So I'm kind of a scaredy cat. I mean, I've had a lot of deals go wrong. I just actually published my third book, and I talk about some big deals that I invested in that went wrong. FYI, so we can happy to double click on that maybe on another episode or show. What's
that book? Just so we have it here.
It's called The Precipice of Life.
Okay.
And there's a whole bunch. I mean, it's about mountain climbing and, great successes and great and spectacular failures. Right. So so I think having that discipline of, group think is a lot of times where I see people, oh, hey, everyone's going into Joe's apartment deal. Right. But it's Joe's second deal or his fifth deal. And, it's just, I think having this discipline of coming up with your 10 to 20 showstoppers, right? Is it a top 10 auditor? Do you want to have them see 40? Do you want 40 deals? Do you want 10? Right? Do you want it to be in your backyard so you can go check on it? Right? So coming up with your list of things that are important to you, I think is very important. Your buy box. I think staying diversified is probably the best defense. And then one of the things that DLP does, and I would ask this question, I would lobby for people to add this to their kind of top 20 list. So DLP, I'm looking for the book right now. It's right over here. But our CEO wrote a book called Building an Elite Organization. And it was the #1 book in the world for a period of time. Okay. It's a Wall Street Journal bestseller, Wall Street Journal, USA Today, and Amazon bestseller. But what he did is he created a managerial operating system. And it's how you grow and scale a business. And 99.9% of companies out there don't use a managerial operating system. Okay. They have meetings on Monday. They have no idea why. They don't track the throughput. They don't track results. So if you have a company of B and C players that has a managerial operating system, they're going to outperform a company filled with A players that don't have one all day long. So at DLP, we accomplish more in 90 days than most companies do in a year because we use this managerial operating system. And you can buy the book and do it yourself. Okay, that's the beauty. That's why we estimate that thousands of companies out there are using this system that Don created. I think that if I were an investor, in this avatar, I mean, I would say, is this person that I'm investing in, does he or she just care about money? Or is there something more? Like, what's their why? Right? And I think that can answer your question, eliminate some of the risk. So like when Don first published this book, some people went bananas, Pascal, because they're like, wait, this is your secret sauce. Why are you sharing it with the world? Well, why not? Right? Why not help everybody? We're at a culture at DLP where you climb a ladder, you look down and there's someone below you and you grab their hand and you pull them up the ladder. And
I think even a couple of people that you guys lend to even use it.
They do. Yep. That's a great point. So actually most of the people that we provide financing to have to use that managerial operating system. There's another system out there, but it doesn't have to be ours. We're not, progress before pride. There's another great system out there called the Elite EOS, Entrepreneur Operating System. That's a great system too. And some people come to us using that. Over time, they end up kind of adopting a lot of our stuff. But you have to use a system, otherwise you're winging it. So that's a big one. You should ask, hey, do you use a managerial operating system to really scale and run your business? The other thing that I look for is I want more than one owner. I just don't want one person to calling the shots. At DLP, there's 3 owners. Don is the majority owner, which is, by the way, very important. I do want, our military, our government, right, runs on, at the end of the day, someone has to make the ultimate decision, be held accountable. So I'm a fan of that, but I do like other owners. Bob Peterson is our CFO. He is an owner, and so is Barry DeGroot, our chief legal officer or counsel. So those are some other things to think about. Hopefully that's helpful to people.
Yeah. And I'm sure we'll continue to have more of these things. I mean, what I want you to pick up on, and as this is somewhat of an interview with, a fund manager here, right? Like we're doing due diligence. We're learning how the investment works. We're understanding what risks are at play. So as you hear me ask these questions and talk, like I want you to pick up like, oh, that's an interesting nugget. That's that kind of lowers the risk here, or oh, that kind of increases the risk. Like that's something I didn't think about before. So as someone's in this space of looking through investment opportunities, and they're they're overwhelmed with the amount that exists. That everyone has their own deal. There's some popping up. You might see Facebook ads. You might hop on different people's lists. And you kind of touched on this earlier, but I want to make it a big cohesive point that for someone who's on that journey, how can individuals manage the landscape and make those informed decisions with maybe that buy box?
This is a great question. We may have to unpack this together, you and me. I may need your help on this one. So
let's do it.
Yeah. There are tons and tons of deals, right? There's tons of noise. There's tons of deals. There's, as you said, social media deals. There's mastermind deals. Oh man, it's really tough. Yeah, I think the first, for someone just getting into it, probably the first move is to just spend a year to learn. To go to as many masterminds as you can, listen to as many podcasts like yours, this great podcast. Just learn and learn and learn as much as you can. Another thing that is good to do is you could find CPA firms or law firms that work for real estate fund managers. They know who's good or bad, right? The accountants are doing their books, right?
Right.
And they make referrals. Right. I mean, they unapologetically, right? They don't get paid to do it. Hey, you should go talk to this firm. And odds are they're going to recommend one that's doing well because they care about their reputation. Right. And lawyers and accountants are professional people. They swear an oath, I think, for, code of ethics and honor. So that's a place where you can help. I think group due diligence is important. Right. That's a great way to figure some things out. What do you think? You jump in.
Yeah, I mean, I'm very, very much on the same page. I think a lot of what when you first get into these deals, I mean, God, I don't know how many people I've talked to where, they see a deal, their friends investing in it, and because their friends investing in it, they're like, all right, I'm in for 50K. And so, that's, I think, on the spectrum of, I do no due diligence and I'm just investing because, someone I know is. And then there's the opposite side of the spectrum where you're, a huge financial, firm and you have like a team of 6 analysts that go in and do all this due diligence. And, and I'm not saying that there's a right or wrong way. I mean, I will go out and say I think investing just because your friend is in it is the wrong way to do it. But, there is I get that people have their own lives going on. This is a new language. It's foreign to them. But this thought of that you spend, a majority of your life building your wealth, and then in a matter of a couple days, you invest in a deal that you didn't really research, and that money is gone. I mean, I have friends that have lost a ton of money in there, and they're in their 30s or 40s, and that's money they won't get back, and that set them behind. So, I very much agree with this idea. We have different text groups. We're going to start one here eventually at Grow Your Cashflow, where people can just kind of, hey, I'm looking at this deal. What do other people think? Oh, I don't like it because of X, Y, and Z. Oh, well, I take that note in, I put it on my scratch pad, and I'm like, I don't think that's a big risk. Or, oh, that guy made a great point. So I think the groupthink is probably where I think there's the shortcut. If anyone is going to get into this, it's just like, get opinions from 5 to 10 different people who invest in these things. Hey, man. Hey, Bo. Or you can send an email to me like, hey, I'm looking at this deal. What do you think? And I'd be like, I don't really like it because I can find better deals. Or, super valuable information. You?
Yeah. So I'm glad that I love the comments you made, and I'm just going to kind of pigpile on some of those. So this is, for those of us that have listened this far, you're going to get perhaps some of the best nuggets of all. Okay. So you get rewarded for the journey you've been on with Pascal and I. So this is a big, big deal. So if you're going to build a diversified stock portfolio, this is just math. Okay. Math and statistics. You have to own 30 different stocks to be statistically diversified. And by the way, you're just barely scratching at the surface. You're just barely statistically diversified. It should be more like 50. But you need 30 individual stocks, say this again, to be statistically diversified. And you're just barely. So I talked to someone in our community. I'm not going to say who it is. Okay, Pascal. And he's like, oh, I'm diversified. I don't do investment funds. I go deal by deal and I do syndications. And I'm like, okay, how many are you in? He goes, I'm in 40. And I'm like, okay, with how many different fund managers? Yeah, I'm sorry, how many different operators? He goes, 2. I go, I'm like, dude, you're in 2. That's 2 stocks. You're in 2 stocks. That's the scariest thing I've heard all year.
Absolutely.
And he looked at me like I had 3 heads. I'm like, you're. I mean, I would be afraid of your balance.
Right. Like if that guy goes, if one of those 2 go bankrupt, or if one of them gets hit by a bus, or one of them, it's like, yeah, you might be in 20 deals under that one operator, but I mean, that's still half of your portfolio. And look, these are just the additional lenses. There's all different lenses that you need to look through these on, and that is a great point.
Yeah, for sure. And one of the things, so I guess if someone's just starting off, or just your mindset is, if you're going to do syndications, okay, but get ready to do 30 of them with 30 different companies, right? So that's the mindset. Funds, have their advantages and disadvantages, but a fund. We have a housing fund. So one of our funds at DLP that I didn't talk about before is our value add housing fund. It's a roughly $2.2 billion fund. There's about 15,000 apartment units in there. Got a great track record. Well, we had 2 deals in there that didn't perform that well. And by the way, when you go to our data room, every single asset's listed. Is it performing or underperforming? Right? What was the going in cap rate? What's the exit cap rate? What's the NOI? Right? Like, are we on budget, off budget? Like, huge transparency is so important. But we underestimated these 2 deals in Shreveport. We underestimated how tough of a market Shreveport. We didn't quite have the resources there. We didn't have that local knowledge. And we ended up selling both those deals. One of them, we barely made a little bit of money. Maybe the other one, we made 6 or 8%. That was clearly not pro forma at all. But if those were 2 syndicated deals and you had put a chunk in and spent 5 years, I mean, that would hurt. That would hurt. But with 15,000 units, you couldn't even feel it, right? So that diversification is something to consider as well.
Yeah, I mean, I also think a lot about this concept of syndications versus funds. And if you're just, I mean, I'd love to understand your take, but I think syndications are unique because you get to underwrite, if that's what you like to do, underwrite a specific deal. And, that's for like the geek that really wants to get in and understand what's happening. And then there's the fund approach where, as I'm investing, I've invested in particular syndications, like projects. Like I invested in a multifamily project here in Denver in my backyard that I was able to drive to. I know the area. I see how gentrification has been happening. And so like it felt, and like I've been in real estate for the last decade. And so that felt comfortable enough for me to go in and do something and make an investment there. But largely when I think, this is another lens to think of it through, is like, what are you trying to do with your money? Are you trying to diversify it and to make sure that you're keeping most of it, or are you trying to grow that wealth? And my current perspective is, if you're trying to grow wealth, that syndications are maybe more in line for what you're trying to do. But if you're trying to like protect your money and still have it, I mean, most of your funds are double-digit returns still, which like better than you can get on the stock market, on an average basis. I think of funds as a great place to kind of keep money safe. What's your take? You can disagree with me.
Yeah, no, I agree with you. And for those of you who are listening, the beauty of this, there's always exceptions to everything. So we know that. But I think, but in the spirit of it, I would say, it's a tough
it's a
one.
showstopper.
It's a
Yeah, I
tough
mean,
one. Yeah.
why is it tough? What's the
Because
the nuance?
for just take so I've invested in some private equity funds that have bought businesses, right? So they buy businesses and then and typically, and I like finding private equity funds that are raising between 200 and 500 million. That's their fund size, right? So like it's not like KKR or Blackstone that are raising 40 billion, right? Because they just have to buy bigger companies. So they're below the radar, that 200 to 500 million. They're kind of finding pretty good sized companies, and they're fixing them up and they're selling them. And I've typically gotten 3x return in 5 to 7 years on all those, right? 3x. I mean those are funds, right? They're buying 20 companies, not startups, to be clear. This is VC's private equity. So those are pretty stout returns, right?
Right.
The same people that don't really know real estate, they like companies. To your point, they want to underwrite the company. They do deal. There's also groups out there that do deal by deal, and you can kind of build your own private equity portfolio. And again, you just have to be ready to do 30 of them, or if you're a high income earner and you're just in your mind like, I'll get to 30, but I have to start somewhere. But you could say, generally speaking, I mean that syndicated deal, they're going to try to get a little bit higher. Generally, I would say probably agree with you, because if they're doing a syndicated deal, they're not big enough or they don't have the experience to raise a fund. So they really want those deals to go well, right? So hopefully they've really scoured the earth and they're going to got mom and dad's money in and they're going to go hard. You could kind of argue it either way, but I think that if it were me, I would pick the funds, because again, I'm kind of a scaredy cat, and I just don't want to take single asset risk anymore. I just don't. But nothing wrong with people that do, and no worries.
Yeah, it's just a different way to play the game. So this was awesome, Bo. Any kind of like final thoughts or we feel like we covered a lot of ground here, lots of nuggets. Any final just notes or I guess suggestions, tips? First thing to keep in mind is as someone's like maybe done one or two investments, they're on their journey and they're looking through picking operators and trying to make sure they don't make a mistake. What advice do you have for someone along on their journey? Like top 2, top 3 tips.
I would say learn as if you were to live forever, and live as if you were to die tomorrow. Right. So keep learning. I want to repeat what I said earlier. The modern day survival skill, everybody, the modern day survival skill is learning how to manage your wealth. It's just so important. And if you have kids or grandkids, take them along with you on that journey, for sure. And I'd stay diversified. Those are some of the big ones, and keep, part of that education piece. I think your podcast is very good. So you do a nice job. You pour a lot of wisdom and value into people. So I'd also encourage them to keep listening to your podcast, and to reach out to you if that's okay, because you have great insights and you know what you're doing. So, I really appreciate you having me on your show, and it's just such an honor and privilege. And check out DLP Capital if you want, and if you don't, that's okay too.
Yeah, no. So thank you so much for being on the show, sharing your valuable insights on achieving financial freedom through these passive income, private placement investments. It's been an absolute pleasure having you on the show. This was super fun. And to our listeners, if you found today's episode valuable, be sure to check out Bo. It's dlpcapital.com. We'll have a bunch of these links and more stuff of way to contact Bo and DLP in the show notes to learn more about their work and the kind of opportunities that they have. And just remember that taking action and going into doing kind of research and digging in more is the first step towards reaching your financial goals. So good on you for being here. Thank you all for tuning in, and we'll be back for another insightful episode soon.
All right, now I have some final thoughts for our listeners. There are over 350 of you who are already on our email list. But if you are not already, if you'd like access to our database of private placement opportunities that we see every week, and you want to get first look at those opportunities that we put together at Grow Your Cashflow, you can join our investment club at growyourcashflow.io. Now, if you found this helpful, don't forget to share with that friend who might benefit from this particular episode as well. And lastly, if you have any questions, suggestions, or just loved a particular show, reach out to me on Twitter at Pascal Wagner 1. Thanks for joining us, and I will see you on the next show.